Imagine a powerful entity with the ability to control the flow of money and steer the economy. This is the central bank, the unsung hero of the financial world. Central banks hold a unique position in the economic landscape. Their decisions ripple through financial markets, affecting everything from borrowing costs to savings. From setting interest rates to regulating the money supply, central banks wield extraordinary power. They maintain economic stability, foster growth, and keep inflation in check. Let's explore the epic role of central banks in the economy.
Central banks are the financial institutions at the heart of the economy. They implement monetary policy and ensure financial stability. Unlike regular banks, central banks manage the nation's money supply and banking system. They act as the government's bank, managing currency and overseeing the monetary system. They provide financial services to the government and commercial banks. Central banks regulate and supervise the banking industry, preventing bank failures and protecting depositors' money. In many countries, they maintain price stability by keeping inflation in check. This preserves the purchasing power of money, ensuring stable prices for goods and services.
Inflation is one of the most significant challenges that central banks face. When inflation is high, the value of money decreases, leading to higher prices. To manage inflation, central banks use various monetary policy tools. Adjusting interest rates is a common method. Raising rates cools down an overheated economy, while lowering rates stimulates activity. Central banks also control the money supply through open market operations. By buying or selling government securities, they influence the amount of money in circulation. Monitoring economic indicators helps them make informed decisions. Controlling inflation requires balancing economic growth and price stability. Central banks must be vigilant and proactive to maintain the economy's health.
Central banks have a powerful arsenal of tools to manage the economy. These tools influence the money supply, interest rates, and financial stability. Open market operations involve buying or selling government securities. Buying securities injects money into the economy, stimulating growth. Selling securities reduces the money supply, cooling down the economy. The discount rate is another critical tool. Lowering the discount rate makes borrowing cheaper, encouraging lending and investment. Raising the discount rate curbs excessive borrowing and spending. Reserve requirements are the minimum reserves banks must hold. Adjusting reserve requirements influences the money available for lending. These tools enable central banks to steer the economy towards stability and growth.
Interest rates are one of the most visible and influential tools that central banks use. They impact everything from consumer spending to business investment. Central banks control short-term interest rates through monetary policy decisions. Setting the benchmark interest rate influences the rates banks charge each other. This affects the interest rates consumers and businesses pay on loans and mortgages. Lowering interest rates makes borrowing cheaper, boosting economic activity. It encourages consumers to take out loans for big-ticket items and stimulates business investment. Conversely, raising interest rates makes borrowing more expensive, slowing down spending and investment. Higher rates combat inflation and prevent the economy from growing too quickly. Interest rate policies are crucial for achieving price stability and sustainable growth.
During economic crises, central banks play a crucial role in stabilizing the financial system. They act swiftly to prevent financial meltdowns and support recovery. Providing liquidity to the banking system ensures banks can meet obligations and continue lending. Liquidity support prevents panic and bank runs, maintaining financial stability. Central banks use unconventional monetary policy tools during crises. Quantitative easing involves purchasing large amounts of financial assets to inject money into the economy. This lowers long-term interest rates and stimulates economic activity. Central banks often coordinate with government agencies for fiscal stimulus and regulatory reforms. These efforts restore confidence, support growth, and ensure financial system resilience. Central banks' decisive actions can mean the difference between prolonged recession and swift recovery.
Central banks are the cornerstone of economic stability. Their role in managing inflation, controlling interest rates and ensuring financial stability is vital. They work behind the scenes to steer the economy through both calm and stormy seas. Their tools, from open market operations to interest rate adjustments, influence economic conditions. Central banks' actions during crises demonstrate their importance in safeguarding the financial system. As we navigate the complexities of the modern financial world, their role remains crucial.